This is a Momentum Media production.
Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
G'day everyone and welcome back to another instalment of the Property Showcase. I am your host, Tom Gilmore, Media and Marketing Strategist here at smartpropertyinvestment.com.au. Guys, as always, I'm going to jump straight into things. And what I want to talk about today is how to navigate your portfolio through a rising interest rate environment. I think this really stems off, I can talk personally off the back of this too, and I'm sure we can all relate to this. There's a lot of stresses around interest rates going up at the minute. And I think it might be quite a good idea, maybe just do a little bit of fact checking, just calm the nerves a little bit and actually really understand what's going on in this ever-changing environment within property and what we should really be expecting in the future. There's honestly no better person to be talking about this topic, none other than Sam Gordon. He is the director of Australian Property Scout. And we've been working with Sam now for many, many years here at SPI. And there really isn't anyone better who works right across the nation who could talk about the evolution of what we're seeing in property. Sam, mate, how you going?
Tommy, good, thanks, mate. Good, mate. How you doing?
Yeah, really well. Thank you, mate. How was your weekend?
It was good, thanks, buddy. It was good, mate. It was not as green as the lush backyard I can see behind you, mate, at the farm. It looks good.
Yeah, mate. I'm up in Tamworth, just doing a bit of recon for everyone here at SPI, going regional. We're checking properties everywhere, mate. It is very green.
I love it.
But Sam, I think the best way to really kick this off is perhaps maybe a bit of a recap. Let's paint the picture here. What's actually going on in the market today?
Yeah, mate. So look, obviously we've had a couple of years, 2 years in particular of exceptional growth. The market, as we all know, had a bit of an awkward period in the early to mid phases of 2020. Stock kind of leveled right out and dried right up. And then the market's been on a very, very strong bull run since then. So we've been talking a solid 18 to 24 months. It's been running pretty hard. There's been a lot of investors that have really jumped on the essentially the gravy train of the growth run that's been on and hasn't been thinking kind of as much around cash flows potentially as much as some people probably should have. And man, everyone's been riding a very, very good run for the last 18 to 24 months. Now, you coincide with that the fact that vacancy rates have been dropping a lot as well. There's been some really, really good rent rises that have been coming across the board, and I think they'll continue coming. People probably haven't, again, been stressing too much because rents have been rising too. But as you and I both know, mate, the chatter has started and it's starting to build to a pretty decent level now around interest rates potentially increasing. It's not so much a matter of if, but when now. And yeah, it's something that people have to be quite, I guess, conscientious of moving forward and what's going to happen. And especially these people that have built very large portfolios, potentially from quite a low yield perspective. It's having a look at how do you insulate against that, moving forward within their own portfolios.
So let's use a scenario here, right? Let's just say, let's talk about Joe Blow investor or Jane the investor here. She's got she's just acquired 3 more properties in her portfolio throughout past year and a half or so. She's done quite well, but now through this tipping point and where we actually see things going, what can an investor do right now who may be finding themselves in a little bit, not so much strife. I don't want to say strife. I don't want to stress people out.
But uncertain waters, right?
Yeah, exactly right. Yeah. Uncertain waters. What can people do right now?
I think the main thing, mate, is assessing the portfolio. So assessing the portfolio is the biggest thing because, in my opinion, if you've got a property that's had a really good run off the back of COVID, and it's kind of purely off the back of COVID, in the sense of super tight stock and all the rest of it has driven a boom there, but potentially that's going to come off the boil, especially over the next 12 months, and then plateau over time. If that's the sort of market you own property in, it's probably one worth looking at and considering and thinking, can I hold these for one if interest rates go up by potentially a percentage point or two over the next few years? And for two, is it actually the right decision to hold these properties, or is there better things I could be doing? If potentially something's done a very big run, could I look at potentially selling one of these off and rolling that into two stronger yielding, cash flow deals, which still could be in very good growth locations, but have, instead of being a very low yielding, call it 3%, or we could potentially roll it into 2 at 6% or something like that. Like, what does that make the portfolio look like? And there's some people out there that make really good income, and it's not a worry, it's not a stress. But mate, there's other people that, if that may not make anywhere near some other people, and may not be on a huge salary. Mate, I know when I started, I was only making 35 grand a year. This is back in 2009. The first property I ever bought, the interest rate on it when I settled was 7.19%. There'd be a lot of people out there that couldn't even imagine those times. And it was heavily negative. I didn't realize it at the time when I first bought it. I was only 19. I didn't realize it was going to smack me as hard as it did, but it was a learning curve, on that. And I think people need to have a look at their portfolios and really assess them, and potentially start doing some forecasting, like not just assess them at interest rates at the moment and rents where they are at the moment, or even potentially a little increased, but have a look at what the rates are like, maybe with an extra 0.5% or 1%, or even do worst case and have a look at a 2% increase. Just have a look at what it's looking like for you, but then also assess the markets of those properties you're in. That's the biggest one. Could that capital be working better for you somewhere else? Can you recycle the capital and the debt into some other deals that could perform a lot stronger for me, both from a growth, but also from that cash flow perspective? There's just two things you got to look at there. And if you could get a much better balance across it, then it could be a very good decision to do that instead.
So let me give you let me give you a scenario then. Yep. Let's just say I'm coming to you. I've got 3, 4, 5, whatever properties, right? And I'm looking at my get out of jail free card, right? Whether it be using equity or cash flow, looking to get out of jail, right? Yep. It's just before the interest rate goes up.
Yeah.
How do I, for lack of a better word, convert? How do you assess someone coming in with that portfolio? You look at this and you go, all right, this is what we're going to do. How does that conversation go?
Let's say you build a 5-property portfolio and you look at it, and at the moment you're running pretty neutral, pretty even, or maybe even slightly in front. But if you ran your numbers and you looked at it, if interest rates went up 1%, I would potentially going to be $20,000 a year negative across these 5 properties, which could be quite a reasonable, quite an honest scenario. If you got 5 at 500 grand and you got a low yielding asset and the rates move in that sort of way, it could be very viable kind of scenario. I would have a strong look at the markets that those properties are in. And I would potentially looking at potentially selling 1 or 2 of those off. If, let's say, that had really, really strong growth, and you had, say, let's say you had $250,000 in 2 of these properties, you could sell them off, pay a bit of tax, maybe clear around 200 grand a property. That's 400 grand you could go and recycle into. 400 grand, you could realistically recycle that into easily 3 or 4 other properties into different markets that haven't seen as much growth. We could have much higher yields and really just build that safety net of cash flow within those as well, but also be in markets that are at a lower point in the cycle, so you can actually get that growth on top. And that's what all the best investors do. Me personally, I regularly recycle debt and equity out of markets and in and out of markets like that. I'll literally paint exactly that picture I was talking about then. I've obviously got quite a large portfolio. I've just sold 2 properties of my own in Sydney because the markets that they were in, which was in the Southern Highlands down south of Sydney, I looked at that market. It had an exceptional run off the back of COVID. A lot of properties that had doubled for me between 2013 and 2017 doubled again or went very close to it. Do I see that market doing another big run in the next 10 years? No, I don't. So I've sold the 2 of them off. I've cleared a substantial amount from each one. And that's a huge amount that I can then go and recycle into like this, some higher cash flow deals that are going to keep me well insulated and actually provide me with surplus cash flow. So that's a sort of scenario that I would be looking at doing with, say, Jane Blow or John Blow, whatever the hell he said. I would be looking at doing the same thing. What can we look at that we've had exceptional growth and go and recycle those profits into something else? And a lot of people, they hear capital gains tax and they think it's a dirty word. And they think it's a dirty scenario. Yeah. Capital gains tax means you've made profit, and that's mad. That's what we're in the game for.
That was the whole point as to why we were doing this, right?
Exactly, man. You need to win, right? You need to win. And the other thing too, man, it's not just like winning on paper. Like when you recycle it out of that into another deal that starts paying you actual cash flow weekly or monthly or whatever, you're feeling that profit as you go each time. You know what, man? Like I probably should have thought this before when we were saying it. When I got to 7 properties, I hit a wall in my own portfolio, and I had to go back through and reassess my portfolio. This was back in 2016, I think it was 2016, 2017, something like that. I had to go back through and reassess, and I had to look at all my properties. I only had 1 low yielding asset in there. It was the very first property they ever bought. It had done about $270,000 worth of growth, and I sold it. And when I cleared those profits, I literally recycled those into 2 other deals, and it completely changed my portfolio. That thing was $5,000 a year negative. And I went and I bought a unit block and renovated the four units. That was just over 20,000 a year positive. And then I also bought land and built a little duplex sort of style setup on that as well. And that was over 25,000 a year positive rolling into those 2 deals just a few years ago. Like that was literally a $50,000 turnaround within my portfolio in the space. It was around about 15 months from when I sold that to then did those 2 deals. And it completely man, that's why I'm so passionate about this, because those, triple acts there by selling that and doing those 2 deals, that has then springboarded my portfolio in 4 or 5 years or whatever it's been since then, man. I'm at 35 properties now. She went from 7
I was about to say.
back to 6 up to that. And man, cash flow and serviceability has so much to do with it. When you're carrying these negatively geared properties, banks don't like them because you're not making money on the way through. So when you can flip the table on it like that, man, it's a absolute complete game changer when you can roll something and build it like that.
Negative gearing, personally,
no swearing on the podcast, Tom. You told me that.
No, there is. You're very right. But let's use that scenario, right? How do you manage that? How do you bring that in? Someone who's got, again, it could be 2 properties, it could be 5 properties, but they're all negatively geared. I mean, God bless you, however you can figure that one out. But how does that then translate into what you can do for people?
Got to assess the opportunity cost as well. So even if the property hasn't made much money and it's sitting there costing you money, and we're about to go into interest rate movements, unless you're very confident that property is going to grow, it's opportunity cost of not selling that and buying better quality assets. It's a mistake a lot of first and second time investors make. They might buy 1, 2, maybe 3 properties, and they make mistakes with what they buy, and then but they don't want to consolidate the loss, even though it will probably cost them more money. It could potentially cost them more money. They don't want to consolidate that loss, when a lot of the time consolidating it, moving on and buying better properties is actually going to allow them to build a lot better portfolio from that point. So don't look at it as like it's a loss, but it's a lesson. You got to learn from that lesson and just build it differently.
What do you think I don't think there's necessarily like a stopgap, but like a timestamp. What do you think the timeline is just for the remainder of the year, just to, just be smart about what you're doing? Everyone tuning in, it's, we're all trying to be the smart players here in terms of what we're trying to invest in, what we're trying to achieve. What do you think the timestamp is on this to make a move before it's too late?
I think that's very personal. It's very personal, because different people are going to have different incomes and kind of different cash flows within their portfolio too. I think we will probably see an increase potentially too before the end of the year. So it's something that people have got to factor into their numbers. I think next year we'll definitely see more again beyond that. I think people, they need to assess the portfolio they've got now, right? Are there levers they can pull on their existing portfolio? Can they develop something further? Can they renovate it to boost rents? Have they been a little foolish and kept someone on really low rents because the rates are so low? And are they $100, $150 behind market rent? Can they literally just do a quick cash flow boost by doing that? I know I personally have been guilty of that before as well. Many years ago, just thinking, looking after a tenant, but realistically, you're not looking after yourself. So you have to do that as well. Assessing things like that, assessing, can you access and recycle equity out, or is it the right time to potentially sell something and move it into these higher cash flow assets? That's something that takes time, right? So I think now is the time to assess the portfolio. Is the portfolio producing? Is it going to continue to produce? Or do we need to cut some of these nice big juicy fat cows that have grown massive before they get, old and wither and die on us, You want to consolidate
the farm references, mate.
Loving wins. It. Mate, you've inspired me with the backsetting there. But it's something, man. It's something you've got to you can't leave it till it's late, because when it's late, it's too late. The market's still pretty good. So if there's things there that have the potential to sell for good money and you can recycle it and take advantage of that, you're better off. As like me, I probably could have held out a little bit longer with my Sydney ones, but I've already seen the market turning a little bit where I sold those. So for me, it was definitely the right decision to sell when I did.
Well, I tell you what, I actually want to give the people tuning in a bit of an offer then, because if it's time to assess the portfolio, I think maybe give them a little bit of a head start. Why don't they just assess it with you and actually try to figure out what they're going to do next? Because if you do feel like you are in a bit of I won't call it a hole, but let's say that you are a little bit nervous about what's coming up on the horizon, there's no better time to do something about it now. So, Sam, how do people get in touch with you?
100%, mate. So obviously, mate, we're all over the socials as well. Obviously, your Facebook and your Instagram and stuff, Australian Property Scout. If you go to our website as well, you can inquire and book in direct for a call with our strategists as well. And who obviously we assess the portfolios, see what we can do with potentially what we could help you with, and kind of really help build off the back of that. Obviously, the website to get to that is the same, www.australianpropertyscout.com.au. Yeah, mate, you know me, mate. We love to help people with their portfolios and kind of keep moving forward and start building the cash flow in the very strong rising markets, mate. That's what we're all about.
100%, Sam. I just want to thank you so much for having this conversation with me today, mate. It's been really, really helpful and really, really insightful. And just on top of that, guys, if you want to just click the link in the description, just within the bio there, whether you be on Spotify or you're listening to this on Smart Property Investment itself or iTunes or whatever platform you're tuning in on, you will see the link there to Sam's website and get in touch with him there as well. Sam, thank you so much, mate.
Tommy, thank you, Matt, as always. Take care, buddy.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.